Okay, why don't we go ahead and get started here? Thank you all for participating in RedeConnect 2026 and for joining us for today's panel, where we will explore the opportunities and challenges in building a next-generation private credit firm. My name is Charlie Savinar, a principal and credit specialist based in Rede's New York office. And just a quick housekeeping note before we get started, if you would like to ask a question during the session, we ask that you do so via the chat box. We have all seen the headlines documenting the inexorable rise of private credit, characterized by ever larger funds, increased competition, and ongoing consolidation at the top of the market. Today, we look beyond the headlines to examine what it takes to build a modern private credit manager, equipped to both capitalize on emerging opportunities across the credit spectrum and to capture discerning LPs' attention as allocations to private credit continue to evolve and mature. I am joined by four experienced practitioners who are charting new territory within their respective markets, having drawn on their prior experience to build next-generation credit firms fit for purpose in today's market environment. Let's begin with introductions and a brief word on each of your firms. Jacob, why don't you kick us off?
Thank you very much, Charlie. Really excited to be here, and thanks everyone for dialing in. I'm the founder of Kinnett & Hill, which was established 2024. We're a new private credit platform in Europe. Before setting the firm up, I was a former senior executive at Park Square, where I gained 2 decades of specialist credit experience. Before that, I was briefly at Merrill Lynch and also at the Linde Group. So Kinnett & Hill essentially partners with performing European mid-market companies to provide bespoke financing solutions across the whole capital structure, from senior debt to highly structured junior debt, including some minority equity. Our strategy essentially bridges between vanilla direct lending and distressed lending, what we call capital solutions for the mid-market.
John?
Sure. Good afternoon, everyone. My name is John Ferguson. I'm the co-founder and partner at Ashgrove Capital. I started my career roughly 25 years ago in a leveraged finance role at Barclays, and then was part of the founding team in 2007 at Ares. In 2014, I also started a new private credit unit for Goldman Sachs within their European Special Situations Group before founding Ashgrove in 2019. We at Ashgrove are focused on providing anywhere from 10 to 50 million of financing to lower mid-market businesses across Europe. Think of these as businesses with less than 200 million enterprise value, but critically focused solely on B2B software and B2B recurring services assets across that European geography landscape. And also backing roughly 50% of those businesses which are founder-led and 50% which are either growth equity, PE, or indeed late-stage VC. The product we provide, albeit its financing, is senior secured with the control lender, sole lender, and ultimately we are providing capital where we're also sitting mostly on the boards of those businesses.
Eric.
Thank you. I'm Eric Smith, one of the co-founders of Locust Point Capital. Locust Point Capital is a private credit manager focused exclusively on investing in the U.S. seniors housing sector. We provide short-term non-dilutive capital across the United States and invest in all levels of the capital stack, from senior debt to subordinate debt to preferred equity. Our owner-operators use our capital to really grow their platforms, typically through acquisition or refinancing of existing debt, and to a much lesser extent, development. We essentially are bridge lenders to these owner-operators, and typically the takeout source for our capital is some sort of permanent capital, typically through the U.S. agency programs, Fannie Mae, Freddie Mac, or HUD.
And Hamza.
Yeah, thanks, Charles, and Rede Partners team for having us here. My name is Hamza Nemsugar. I'm the founder and CIO for Rede Capital. We manage today close to $17 billion AUM. We focus on European credit in a converged play between public and private, opportunistic and performing, and very excited to be here today.
Thank you all. Let's go back to your origin stories. Amidst all this market consolidation, what market opportunity did you identify that provided the impetus to leave more established firms and set up your own firm? Hamza, let's stay with you.
Yeah, of course. I mean, look, not to say good bad things about bad firms, big firms. Um, I think that big firms. I was started my career at Credit Suisse. Have been a great school. I do think that for junior talent, starting at a big firm is incredible. It's you learn a lot. You see all type of people and functions. But obviously, as you know what you want to be and you know what you want to do, big firms become more and more difficult because they want generalists, whereas what we do is really a specialist job. So I wanted, and my team, we really saw that we wanted to invest more and be more flexible with the culture that we wanted to carry. But I think also the timing was really important because we saw the debanking of Europe. We saw that public and private credit markets have to grow exponentially. And we saw market opportunity that the incumbent players were not really funding that gap. And we wanted to take that role. And I think timing is also important. So wanting to invest more, wanting to have our own culture, and more importantly, the timing of that debanking was really the trigger.
Yeah, thank you. John, be curious in your views on this.
Yeah, it's a similar kind of theme. I had a privileged seat at Ares in '07 to see the beginnings, if you will, of the structural growth in what people now call private credit or direct lending, and could see that those structural drivers around bank retrenchment and ever increasing size of those private credit firms, which are now the household asset managers that we're all very familiar with. I think what that did in myself and my co-founders' minds was just highlight the opportunity where you see the dislocation between supply and demand, underneath where those direct lenders and private credit players operate. And so that inefficiency of supply, yet consistent demand, creates a really interesting dynamic where you can put and structure, great credit risk, but get paid, frankly, outsized returns, and frankly, put in place very conservative capital structures as well. So that supply demand, if you like, dynamic, that opportunity set was very apparent. The second thing I would say is what was critical to us when we were kind of making the decision to do so was that it's very much a structural trend. This is not a trade. Whatever kind of decision you make as an individual, right, that has to be repeatable. It cannot be, and sustainable. It can't be just a trade and idea. Otherwise, it's very difficult to build a business around that. And then I think the final piece is just being thematic, which I know we'll talk about later, but being able to generate unique risk and risk reward is quite different, and therefore creates a differentiated prospect for our investors. And therefore, being thematic was very important to us because that creates a lens of added credit collateral to the dislocation I've already mentioned.
There are many different aspects and considerations that go into building a modern private credit firm. I think we can all agree on that, from firm architecture to team building to defining your right to win, just to name a few. What is your definition of a modern private credit firm, and how has this influenced the evolution of your firm? Eric.
The first wave of private credit was really largely in response to the pullback of banks as a result of the GFC. Most of those initial platforms were generalists, really focused on upper middle market corporate loans. The opportunity is pretty straightforward. Capital stepped in where banks stepped out. I think today's landscape looks a little bit different. Private credit is moved well beyond the initial stage of filling a role. It now touches a much broader part of the market in an environment that is where firms stand out are ones that really focus, in my opinion, on a specialty or a segment of the market. At Locus Point, we made a deliberate decision to focus exclusively on the U.S. seniors housing sector. We've been lending and investing in this sector for nearly 30 years. The senior housing really sits at the intersection of real estate and healthcare. It's operationally intensive, highly nuanced, and you really need to understand the labor pressures, regulatory framework, payer mix, clinical considerations, and the real estate fundamentals at the same time. If you're not fully immersed in this ecosystem on a day-to-day basis, you're just making assumptions where you should be exercising judgment. To me, a modern private credit firm does not really diversify away from complexity. It really leans into it. It builds on the institutional knowledge of a specific vertical, structures around capital and insight, and really understands the risk and cycles that sector is involved in. It's really more about the depth, not the breadth of a complex investment cycle.
Yeah, thanks, Eric. Jacob, I'm curious in your thoughts on this, coming at this from a different perspective.
Yeah, absolutely. You know, Eric touched upon the market evolution, which is very, very similar here in Europe. But I want to focus a little bit more on the cultural evolution and then get into what we think is a modern credit firm. And again, you have to go back in history here. You know, the financial service industry previously was shaped by the culture of the large investment banks. And I think the culture there was very political, as many people here know, very bureaucratic, and there was also very much siloed hierarchies. And I think that really fails to resonate with the next generation of talent. So this culture is quite obsolete. If you then think about the growth of the alternative industry, not just private credit, but also private equity, you know, a lot of the founders of the first generation came from banks. So they tried to change the culture, and they did, but they still carried a bit of that legacy. I think the next generation now, including myself, I've spent all my life investing. I've never really been a banker in my career. And we want to differentiate ourselves and get away from this legacy culture. And for us, what does that mean? First, it means getting the right people and having a culture alignment in the firm. For us, it's about attracting people who want to be winners, but that's not enough. They have to be willing to be team players, part of a winning team, effectively. And finally, they also have to be nice, which is really important as well. And if you get this right, if you get the culture right, you can eliminate all the friction of internal politics, and you can focus 100% on delivering alpha for the investors, which is what we want to do.
Thanks, Jacob. John, one common thread I think across all of the firms discussed here today is specialization, and you touched on this in your intro. I'd be curious to learn more about this specialization piece and how it provides Ash Grove with a competitive advantage.
Sure. So for us, as we focus solely on B2B software and recurring services, there's kind of two key areas, I guess. The first bucket would be at the asset level. So when we think about risk, we always think about the key barometer for risk at the asset level, at the company level, being the quality of that business model, not necessarily per se the size of the business or maybe the geography it's in, but actually fundamentally how solid, how robust is the business model, and critically, how volatile is the value ascribed to that business model. Because as a credit investor, one of the things I cannot live with is volatility around value, right? Because I'm never going to be paid 5 times my money. I can certainly lose all my money. So volatility and value, I can't stand. So I want robust kind of credit enhancing characteristics. And for us, that means subscription recurring revenues, very high gross margins, flexible cost bases we can flex up and flex down to harvest cash to repay interest and principal for our investors. And so the specialization is first and foremost a risk mitigant, a risk enhancing measure by us, which pushes us into the direction of B2B software, B2B recurring services. It is not fundamentally that, you know, we spend a lot of time in B2B software, which we have, and we like it and don't want to do anything else. We think fundamentally that on a risk-adjusted basis, we access better business models. So that's the first point. It's really about creating, to Jacob's point, creating alpha in terms of the risk-adjusted returns we offer our LPs. And then the second piece is really more of a platform piece. So when we think about our business, we like the flywheel effects that we have as a thematic investor. So I implied that we underwrite from a position of value. That's where we start, right? And that means we've got to have a very nuanced and educated view on the different values within B2B software subsegments and how those businesses and unit economics of the individual asset at the ground will dictate valuations and how those valuations will move across the cycle. You can't do that as a generalist,
Yeah.
which is, I guess, similar to Eric's point. You really, really have to have a tight and nuanced view on value underwriting. And that obviously means your underwriting gets better and better and better as you traffic in more opportunities. It feeds obviously into origination. I think probably that's intuitive, right? Deals beget deals. You're known in the ecosystem. You have greater access, credibility, and you're simply known for that. And then I guess the final kind of 2 points are probably less obvious. You're more able and frankly have a right to add value to those portfolio companies, which is pretty rare for a credit investor. But as a credit investor that is able to look at complex situations and sometimes participate in equity upside and sits on more than 2/3 of the portfolio company's boards, that's actually quite valuable to our counterparties, whether that be growth equity houses or founders. We can provide value as a thematic investor. And ultimately, all those points at the platform level equal, better outcomes for our LPs.
Yeah. Thanks, John. Well, any discussion of a next generation private credit firm must take into account the impact of AI, which has become increasingly topical over the past week as we've seen a number of publicly traded alternative asset managers sell off over fears that AI-related disruptions will cause losses on their loan books. Eric, Locus Point has been quite deliberate in how you integrate technology into process. I'd be interested to walk through that with you and how some of these initiatives at Locus Point have provided you with a competitive advantage and also a platform to be able to grow.
Sure. So I just want to talk a little bit about our platform because it's why we have been so aggressive using AI. So we typically are lending at the lower middle market, typically at the subordinate debt level. So our average transaction sizes are somewhere in that 5 to 10 million per transaction. We're typically underwriting and closing on 50 to 60 transactions annually. And 80% of all the investments we've made to date have been with repeat relationships. So we typically have multiple loans out to the same operating company at different facilities. Because it's a high volume business, we really need to automate the process. There's two ways you can combat. You can just throw people at this in order to do that high volume of business at the same quality of underwriting, or you can automate the entire process. And so we've chosen to automate the process, spent the last 3 years really building out our technology platform that has really allowed us to remove the analyst and associate from more of the data entry level and really focus their time and attention on analyzing much more complex underwriting. And so when a transaction comes in, we feed it into our model. It spreads all the financials. There's no longer a human involved in spreading financials from the operator into our database. The database then collects and compares all of the data from that transaction to all the other transactions in that market within our database. Since we've been lending and investing in the sector for almost 30 years, we probably have the second or third largest database of senior housing information in the US. And why that's important is because we're able to compare and contrast. Since we're a sector specialist, all the data that we're collecting on all the properties we're investing in is really homogenous, right? It's each transaction is different data, but it's all the same types of information that we're collecting. And so we're able to use AI to track patterns. When the transaction starts to deviate from pro forma, we're able to use AI to alert us as to what is going on at the facility level. We're then using that information to hold calls with our owner operators and really spend much more of our time analyzing information than and really data entry. I think the other interesting aspect is that we're able to use AI to write certain sections of our investment memos. And then also we're able to use AI to draft our loan documents. Once the transaction is approved by investment committee, the system drafts most of the legal documents, which then go to our attorneys, which then starts the negotiation with the borrower's attorney. So we've really fully automated our system with the use of AI through the technology platform that we've developed over the last few years.
Thanks, Eric. Hamza, I'd be curious in your thoughts on this too. Arini analyzes vast amounts of data across the platform, and it's a critical input to decision making. How does Arini incorporate AI and data into your day to day?
Yeah, I think look, there are two parts to that question. There's using AI as a company, and then there's how do we think about it when investing. As a company, all it does for us so far is accelerate some of the manual work, automate some of the manual work, and create operational leverage for our teams. And it allows people to think about real high return on time questions, problems, and opportunities. And it accelerated a lot of the manual work that the analysts would used to do to read a lot of call notes from comps or legal teams reading, term sheets back and forth and comparing line by line. I think there are a lot of interesting solutions that we've integrated over the last couple of years. And that's been really, really improving our efficiency and return on time. We're not at the point where we use it yet for anything more than automating manual things. I think that quality control is really important for us, and we're happy to make sure that to see that the quality control is there in some of the solutions. We're in the market studying different opportunities. It feels that it's still early stage, and very often the hit rate is not enough for us to give up on control. And we're thinking about that. Then from an investing perspective, it's been 2 to 3 years that we're going through every sector, every opportunity, business model to see both ways which businesses will benefit from AI, where margins can improve, costs can be cut, and then what businesses are going to be challenged, as you saw over the last few weeks, with the private credit and software issues that have seen, especially on the bigger cap, over-levered part of the market. It informed us early on, luckily, and it's been 18 months that we told our LPs our views, and we readjusted our portfolios accordingly. And the moves have been pretty good for us so far, and we're looking forward to thinking about the next step, because it's not going to be one and done. It's going to be a multi-year journey of adjusting to this new technology and how it impacts everything.
Yeah, no, absolutely. Thanks, Hamza. I want to double click on a few of the themes that have been raised already and then go back to you, John. You founded Ashgrove during COVID, challenging time globally, to say the least. And I'd be curious to understand how the market opportunity for Ashgrove has evolved since then and what you're doing to stay ahead of the curve.
Sure. Yeah. Look, I mean, I think COVID was a challenging time for everyone across the piece, but certainly it was. You questioned your decisions when founding a business during COVID. I think on a serious note, the structural movement that we've been seeing and structural trend we've been seeing within the broader private credit supply or supply of credit to in Europe. That really accelerated immediately post-COVID. COVID was obviously a very, very strange period, but immediately post-COVID, what you saw was an acceleration of those structural trends, whereby if we cast our minds back, the biggest asset managers accelerated and got bigger, right? Opportunistic funds were raised almost overnight at pretty huge numbers. Those kind of in the more vanilla direct lending space came back out with funds almost twice the size. Meanwhile, the banks again had a pretty torrid time when it came to providing risk capital. So that structural trend was amplified by the volatility within COVID. And I guess that's an interesting point, because that volatility for us as a kind of credit investor that plays away from the middle of the fairway and under the radar of the direct lenders really is an opportunity. And what we also saw within that is then some consolidation, which I think we've all probably seen continue over the last few years, and that's well documented and covered by the media. And that consolidation means that more participants have moved away from the market in which we founded the business 7 years ago. So the way I would categorize it is the opportunity set has become not just deeper, but broader. And so around the edges, we see opportunities to still, write the risk reward we wish to, but perhaps at greater size or perhaps even less complexity than we did 7 years ago, which is super exciting for us as a platform. But ultimately means therefore that you need to focus the mind on evolving your platform from frankly being a founder-led business to an institution. And that involves investing very, very heavily in the platform, as Hans has alluded to on his side, to capture that opportunity set, which is in front of us. And so we have done that pretty aggressively over the last 3 years, both in terms of functional areas, headcount, people, process, elements of AI, portfolio management, all those areas you would expect, almost ahead of, if you like, the size of the platform today, with a view where we will be in the next 3 to 5 years. And then I guess the final piece of the puzzle, right, is take a giant step back. What's changed since COVID as well is LPs' allocation to private credit. It was mentioned at the top, there was a time in COVID, I think, where allocations were far more linear and really focused in on big brand names, big asset managers. Now it does feel like there is recognition of more of a polarized approach, whereby one or two big managers, perhaps beta managers, are the allocation targets for big LPs, and then they're looking to find differentiated and agile strategies to complement that. And candidly, we've been a huge beneficiary of that.
Yeah. Jacob, why don't we pick up on that? I think you fit squarely into the specialist bucket of private credit portfolios. So I'd like to hear how you think about that, and maybe you can also touch more on how important alignment is to Kinnington Hill and the success of the firm and the culture at a high level.
Sure, Charlie. Look, very simply, we strongly believe that focus always wins. Particularly in Europe, which what we've seen in the private credit market, it's become more and more commoditized as these big platforms have become AUM machines, and most of their lending today is really check the box. Maybe AI can replace it, frankly. Look, if you're a company and or a sponsor and you're looking to shave 25 basis points off a loan, then there's just so much options at the moment. And you can go to a dozen high volume lenders who can help you. Where we thrive is really when there's complexity, when you need a bespoke solution. Because as the market has become more commoditized, as the players have become bigger, they left this market for the mid-market complex situation in a bit of a void. And that's really what we are trying to fill. So we come in when you need something bespoke, anything from senior to junior, highly structured, and we can also do some equity as well. And we're thriving in that market. And really importantly, we're bridging the gap between the vanilla direct lenders and the distress, because we don't want to be distressed. We want to be in the middle, good companies where we can provide something bespoke. I think, looking at us, we're not a big machine. We're a small, lean, independent team. We want to avoid bureaucracy, and we don't want to have other businesses. We don't have a CLO business. We don't have a distressed business. We don't have a private equity arm. So we don't have any competing incentives, and investors like that. This is all we do, and we can dedicate 100% of our resources to these bespoke financings for good companies in Europe. So in that way, we're very aligned. And look, if you want to talk further about alignment from a culture standpoint, what we're aiming for is really delegated leadership. And as I said, no bureaucracy or minimize it. And, if you think about firms that have co-head titles, and I hope no one here has that, but I think that's a perfect example of misalignment if you have people running around with co-head titles. We want to avoid that. For us, alignment starts with a team. We have to attract the right people, and I talked about that. We want people to be part of a winning culture, but they have to be nice as well. We don't want to be hostile, not internally or externally. And secondly, we want to share the ownership with our team. So everyone in our team will benefit from the growth of our platform. And that's great alignment, of course. And then thirdly, what we really are looking for is to extend that alignment from our family, our house, to our partners. So our investors and also the companies that we're investing in. So for us, that's sort of the golden triangle of alignment between us, our investors, and our companies. And we're always monitoring the alignment between those three.
Thanks, Jay. On the talent point in particular, how do you screen for talent? How do you solve for that alignment piece and the intangible around culture when you're looking to hire?
Yeah, look, I mean, it's really when we look at hiring someone, it has to start with culture alignment, because there are lots of people that are very smart. There are lots of people that are very good at what they do. And there are lots of people that are good team players, but we're looking for them also to be nice people, because that's our culture. You have to be willing to be a master of your craft. Maybe you already are. If you're not, then you want to be a master of your craft. And you also have to be a team player. We don't want 11 Ronaldos running around the field, right? That's not going to work. They're going to, create a lot of misalignment. So for us, it's about selecting the people that fit our culture. There's no right or wrong here. It's, what is your culture? And then get people that fit in that culture. And we don't compromise on that. And that's why, it's not enough if you're smart and you're very good and you're also a good team player. You also have to be a nice person if you want to work with us.
Yep.
And then you get to benefit from all the upside. As I said, we share the equity with the team because we strongly believed in shared ownership. We see that with companies we invest in, and we want to create it for Kinnett & Hill as well.
Thanks, Jacob. Eric, let's talk about the seniors housing market and how fragmented it is. It's fragmented, it's operationally complex, it requires real specialist expertise, as you've alluded to. And given this, you've been quite deliberate in building Locus Point's platform, particularly around its origination and servicing capabilities. Walk us through some of the dynamics of this market and how you've really been able to develop such a competitive moat in the space.
Sure. It really is a complex business. I mean, if you think about it, these operators are providing housing, hospitality, and healthcare to the residents that they serve. Revenue really depends on occupancy, acuity levels, labor availability, regulatory compliance, and local market competition. So 100 basis point change in labor costs matter much more than a movement in cap rates. If you really don't understand operations, you're just not able to underwrite the risks. As you mentioned, the market is highly fragmented. The vast majority of owner operators in the U.S. own and operate less than 35 facilities. They typically are in a single state or adjacent states. Healthcare is local. There is a complex regulatory rubric. Each state has their own regulatory framework that the operators need to abide by. And so it's very complex business. Even though you have the hard real estate as part of your collateral package, it really is an operating business and you're making a loan to a complex credit. When we founded Locus Point, we weren't really trying to reinvent ourselves. As I said earlier, we had managed two prior fund platforms that both focused on the seniors housing sector. And so what we were trying to do at Locus Point was really to expand our capital base around a strategy that we really understood deeply. We made a deliberate decision to stay focused on our core competency. On the origination side, our competitive advantage really begins with the relationships we build over 3 decades. As Jacob mentioned, these relationships are key have been one of the keys to our long-term success. 80% of all the transactions we've invested in have been with repeat relationships. And over multiple decades, you're able to build that long-term relationship with these operators and really understand their business complexity. You really understand how they look at seniors housing and how they provide quality care to the residents that they serve. The history really does matter in that. And then these owner operators really need this short-term capital. And the capital really is used either for recapitalization, refinancing, lease up, with the ultimate goal to refinance out the entire capital stack to that permanent capital, either through one of the government agency programs, Fannie, Freddie, and HUD. I think it's really important to understand that the underwriting fundamentals of this really complex and fragmented industry. On an underwriting side, we've really built out a team that understands the complexity of this asset class, and we track more than 200 historical transactions. That data is extremely important to us in helping us underwrite these transactions as well as monitor these investments on a monthly basis. And I think that as important as the underwriting, it's really the portfolio surveillance. So after you've made the investment, it's really being able to track all of that data on a monthly basis and compare and contrast that to the pro forma that was presented during investment committee and make sure that the operators are tracking. And if they're not, having those calls with these operating teams to make sure that we understand how they're deviating from the plan and what they're doing about that to get back on plan. And so I think all of this does require deep specialization, data analysis, and you really need to build out the infrastructure in order to create that moat that we have around our business.
Thanks so much, Eric. Hamza, I wanted to talk about Rede and the growth you've had. You've been able to grow across multiple different strategies across publics and privates. How is your original vision for the firm translated into success?
Yeah, I think, look, we see that there's a balance to strike between being nimble, but also being scaled, important to the market, stable, ability to keep talent and see what's happening in the market. An example of that was really the software crisis that the public team on the long short side saw it first. We expressed that on the short book and then communicated it to the team, to long-only portfolio managers, private credit, asset-backed. And then we started thinking about that risk, informing our LPs, and making sure that review happened proactively before now it's becoming topic du jour with all the headlines and the noise. I really think the market rewards people who are proactive. And we try to build a firm that is performance-focused, but still has enough access to the market and information that can be used across silos that we have. The vision was really to monetize on the supply-demand imbalance in European credit, that we see that in public markets. How? More than 80% of the investors are rule-based investors. And so whenever credit gets downgraded, you jump from forced buy-in to forced selling. Even if the company is still solvent, even if the opportunity is investable, there will be a lot of forced selling upon any downgrade. And then a lot of forced buying upon any upgrade. So that's how we see the supply-demand imbalance in public credit. Private credit, same. The size, as the capital structure size goes up, the competition goes up. Public market competes for it. Large direct lending firms compete for it. And we see more opportunities in the mid and upper mid-market side of the market. So we tried to build a European credit alternative firm with deep sector coverage, with deep fundamental understanding of the companies we traffic in, but also specialization in terms of product, and have PMs that know their product, whether it's public or private, whether it's vanilla or structured, and communication. While we respect specialization and the incentives are really to reward the specialists, it is really important for that communication and information to flow smoothly, because there will be moments of a sea change, whether it's the interest rate move of 22, whether it's what's happening in technology today. And I do think seeing it a little bit early can reward the risk manager more than someone who's reacting to the headline. And that's what a converged play really rewards you for.
Yeah. Thanks, Hamza. Well, we've talked a lot about the opportunities inherent in developing a modern private credit firm. I'd be curious in some of the challenges. And so, Jacob, maybe we'll start with you. What has been one of the most challenging aspects of starting Kinnerton Hill?
For sure, assembling the right group of people. We've been very, very selective in terms of especially that culture alignment I talked about previously. If you think about the firm, the three senior partners in our firm, we all used to work at Park Square together for a very long time. So that was relatively easy. We knew each other very well. The rest of the team, as I said, we were very selective. We were looking for a lot of things. For us, when you're starting a new firm, it's important that you also have people that can be a little bit entrepreneurial. And so willing to take a bit of a risk, willing to stretch yourself personally, because in a market that is very competitive, you can't afford to have people that are just one-trick ponies. So we needed to have people to be a bit more creative and can wear multiple hats. So for us, that was key. And I mentioned, the other parts of being willing to be a master of your craft. Either you are one or you want to be one. That's really important for us, and having that alignment with the team. I think when you have the right group of people, it's pretty easy. That's what we noticed, and we feel like now we have a great team, and I'm very proud of the team, and you can roll much quicker, basically.
Yeah. Thanks, Jacob. Well, we have about 2 minutes left, so I might just ask two final lightning round questions to each of you. The first one is around what keeps you up at night? Eric?
I think for me, what really keeps us up or keeps me up at night is really complacency, right? When you look at seniors housing, you have that demographic tailwind. It's really to make sure that given the high volume business that we do, is to make sure that every transaction that we underwrite, it's underwritten to the same exact standards so that we can maintain the consistency over a high volume business.
John?
Yeah, risk. Risk is the thing that keeps me up at night. To Eric's point, risk and discipline, and that's why, Jacob's talked about culture. We have kind of a risk-first culture here, where ultimately everyone sits in IC, everyone's asked to read papers, everyone has a view, everyone is also incentivized through the performance of the portfolio, the carry, etc. It's a very different mindset, but ultimately, that's what you get paid for as a credit investor. And if you have a differentiated and good strategy, you will be able to raise capital. If you fundamentally have a risk-first mindset, that's the key piece. And then the second piece, which Jacob's touched on, is people, which most GPs don't talk about, but it's the glue between the fundraising and the investing. So it's risk. That risk-first mindset that keeps us awake at night and making sure we still have the same talent sat in the office that we do.
Yep. Thank you. Hamza, Jacob, I'll ask you a different question, which is what market opportunity most excites you going forward? Hamza, maybe I'll start with you.
Yeah, I think that we all know that Europe 20 years ago was a banking economy for centuries. A lot of businesses, a lot of balance sheets, a lot of assets. And the transition out of banks has started. Banks want to create balance sheet either to meet regulatory requirements or to grow. And we think that the market presence, whether it's public or private, is still at its infancy. So that growth and the lack of competition on the segments where capital is most needed is really exciting for the next decade.
Jacob?
Yeah, I mean, I don't have much to add. I think Hamza has said it, a lot of people are rule-based, especially in Europe, private credit, and it becomes more of a check-the-box exercise. I think John also alluded to that. And this is creating a huge opportunity for us who are willing to roll up our sleeve, uncover complexity, and are really paranoid about not losing money, So we think there's a huge opportunity for creating alpha in complexity. I think even more so in Europe than in the US, because in the US, the capital base is very, very deep, and you have different types of capital for different types of opportunity. In Europe, you don't have that. you have very large brands dominating the market, and you have some distressed firms doing their things. But what we do in the mid-market for complex things, there are not many people who focus 100% of their efforts on that the way we do. And we feel that's a great opportunity.
Great. Thanks, Jacob. And looks like we're over time. So why don't we stop there? And I just want to thank all of our panelists today and everyone for joining and participating, and hope everyone's enjoyed RedeConnect 2026.